Hello and welcome. We are going to finish this golf course financial model upgrade today. It's the funnest day, the most fun day, day two. It's 10 o'clock Eastern. We're going to get into the income statement, balance sheet, and cash flow statement. Um, so fun day. Let's get our Twitter tweet out. Do a sound check out. Looks good. Do a sound check. Man, I cannot wait to finish these upgrading all these startup models. I'm gonna do. So I've decided. So right now we're upgrading the industry specific category template. Where is it? Golf course. So I've upgraded 90%. I feel like so we're gonna do this one. I'm gonna do a vending machine one and a. Did we tweet that? Oh yeah, we did. I'm gonna do a vending machine one, uh, e-commerce, and then I think after that I'm gonna start spacing it out. So I'll do 1 week. I'll do a brand new template, or actually doing new templates takes longer, so it'll probably be a week or two, and then a week of an upgrade, and we're gonna slow it down now that I've gotten through the top 90% of the starter models. Uh, don't forget before I get into this, I build all kinds of financial models and templates, trackers, tools for all kinds of different industries, accounting, HR, inventory tracking. I've also got a lot of real estate models, mobile home park, multifamily, unit-based acquisition, self-storage, mixed use, seller financing, amortization schedules. This is an interesting one. Short-term rentals, real estate development budget versus actual. I've also got a lot of SaaS models. I've got a lot of joint venture waterfalls that you can use basically with any of the models and just plug in the distributable cash flow. And this will show logic for a GP and LP split, basically for a fund. And then again, you could shop by category, by individual template, or get all the templates on the site for $9.99. Lots of great logic across a bunch of different industries, and it's just super valuable. The things that you get in all of those. All right, well, let's get started here. Okay, so we left off. Thank goodness I don't have a headache. Yesterday was a little rough. I feel a lot better today. So we left off. We're keeping all the revenue logic. We're going to have to do some interesting things with this. Um, the expenses are fine. This is fine. Debt schedule is fine. CapEx, we're going to be doing some things with. Cap table's fine. This is fine. Okay. So revenue, we have two streams. It's going to be um, what are we calling it here? Basically, fee revenue from selling rounds, and then ancillary revenue from food and beverage. So let's go here. What do we want to title this? Basically, course fees. And then now with the food and beverage, do I break out? What do I do here? So all I'm doing is pulling the food and beverage revenue. Okay, so I did separate this out. Just making sure. So I've got that. Now where do I put, there's the food and beverage costs. Okay, so that's going to be in there. That's fine. Okay. Food and beverage revenue. And we just simply reference our monthly detail because it already has all this on here. Those are the rounds sold per month, revenue from the rounds. When you fill this out, it'd be your own assumption, so you'll put in whatever is your based on your course. The assumptions here are simply arbitrary. Okay, looking good. Total revenue. Now, variable costs. There's not really a cost of goods sold, it's just golf course fees. The food and beverage is so on this we did percentage golfers that buy, average order value, total revenue. Oh yeah, cost of goods sold. So there's cost of goods sold for food and beverage, so we'll put that in there. Okay. Even though it's not really like obviously the main revenue is going to be course fees, but you know, it depends. I mean, you might make a lot from food and beverage as well, so we have to put this cost of goods sold in for that. Now, when we go into OpEx, we have general administrative, labor, marketing. Okay. G&A. So on our income statement, we'll have general administrative. Startup costs will be down lower. Remove this for now. So we'll do uh, labor and maintenance, which is obviously a big thing for golf courses. We're going to have marketing and then startup costs. G&A, labor, marketing. Okay, that's all of that. So G&A is this one. Labor and maintenance, marketing. We've got fixed and variable. Startup costs. Okay. Drag it over. Now remember, we have the model ending on November 2027 just to make sure our stop logic is working. So EBITDA, interest, depreciation. This is going to be tricky once we do the CapEx. And then this is fine down here. Okay, let's copy these titles to the income statement annual. Also drag this down. That looks good. Okay, and zero balance, so those match. So the only really difficult thing is going to be trying to figure out how we do this construction and land. So obviously the land purchase is assuming, or there's no depreciation. But I was reading some rev rules from the IRS, and some of the whole construction stuff can be depreciated, like pipes and different things like that. Obviously, the ground and um, like moving earth around and stuff is not a depreciable expense. It just adds to the land basis, the cost basis for the land. So what I'm going to do here, and well, first, before we even get into that, let's look at so income statement is fully implemented. Let's look at the cash flow statement and get this. So we've got income from operations, which should already be referencing everything. Let's see. D10. So revenue. OpEx is, what are we doing? 25 and 15. Yep. And then interest and taxes. Okay. So this is fine. CapEx. Alrighty, so yes, let's do this. Construction land, what I'm going to say is percentage of whole costs that are depreciable. Whole costs don't include land purchase. So let's say, it's going to be some estimate. Let's say, I don't know, 25%. So depreciable costs of construction or whole construction would be this times here. I'm pretty sure we subtotaled these. Yeah, perfect. Okay, so 776,000 is depreciable. Um, and then part of whole construction added to land basis would then be the difference. And so we have total cost basis for land is that plus this. And then these should sum up to, oh, did we double count something? 6.6. Hold on, let me see here. It's 3105. Ah, so this is that total. Oh no, we can't add all these up. So the total cost basis. So this is already including all of this. So this 5.8 million is saying all of this and 25% of this. And let's just double check that. So 25 times here plus, wait, what? 20% of these plus D4. So 25% of that. Yup. 25% is depreciable. 2.3 is added to the cost basis. And that, okay, so that should make sense. So uh, this plus 0.75 times that, 5828. Okay, yes. And then the depreciable part here, and these two, 6605. Okay, good. So that matches up. Let's give these a little underline. And we're going to have to use these figures. So what I was thinking the best way to do this is this depreciable amount, part of the cost is going to go into the CapEx as this. So depreciable portion of whole construction. Now this is going to get real interesting when we figure out how to set up the balance sheet. Now this is going to be a thick bottom border because this actually can't be adjusted. This is always going to be that specifically, which will equal this. The date always has to be the start date. So that's not going to be editable. This will always equal the first month. Um, building, we're just zeroing out, but there could be buildings if you have, and you could put the cost basis there if it's relevant. So this is that. You can put the useful life here. I don't know what useful life on whole construction is, but I'm sure there's guidance from the IRS if you needed it. And then all this other stuff is just regular equipment items. If you're basically, it's going to be maintenance equipment. Okay, so that goes there. Now, to make the balance sheet balance, we then would have to take the land purchase, this, so our cash flow matches, right? That's the total. Yep. Okay. So we're adding that to here. Okay. Now our capital expenditure includes that. So that's this construction area. That's good. Now the tricky part, we're going to have to assume that the land is sold, like if you on the exit value, on the terminal value, we're assuming the land cost is worth, obviously it probably will be going up over time, but we're going to assume some multiple of EBITDA is the value, the total terminal value. However, we will add the value of the land at its cost basis on exit, plus whatever multiple on the EBITDA. Now, every single deal is going to be different. Whenever you sell your business, there's going to be all kinds of different things taken into account. So this is just like a general like rule of thumb, just to show a simulation of potential financial outcomes based on obviously these assumptions. So when we go to the balance sheet, we can keep this. We don't have to update any of this. Um, we have to add an item here though, which is land. And that is simply, since we're assuming it always happens at the very beginning of this whole deal, it's valued at that. Now I have to go and look, because I did another model that had land in it, and I want to see how I did the formula for that. Which was the apple orchard. So here I added land, and I just did, okay, so I'm just going to zero it out if it's past the end month. Perfect. Okay, so there's the value of the land, and then we'll just say if the month is greater than the end month, 0, otherwise just pull me the previous amount from the previous period. And then we need to sum this all up so we balance out. Now when we zero that out, so 0 here, but we're also zeroing out non-current assets because we're assuming all these are going to be sold in, at the sale. If you select yes here, if you select no, you can see this then does not go away and the non-current assets do have a value there. But if yes, we're going to zero them out, but then that cash flow has to hit. So again, let me see here. I believe I just added it. Yeah, I just added it to that sale to purchase land. Okay. So that's fine. So in the sale depreciable assets slash land, we also want to sum up, so it'll just show up on this month. So it goes that some capex H3 to H18, which this is the value at sale. We also want to add the land value. So this plus, and we're assuming it just equals its cost basis, so we'll add it right there. And then, so we have to have that, or otherwise our balance sheet will not balance. Now let's make sure, so we are out by the land value here still, so let's see why. This is always tricky. Let's go to the first period. So we've got this value going up. We're not doing any depreciation. So we're not going to balance until we do 5, 8, 20, 70. We need to do cash flow, or required cash flow. So that's going to come from the monthly detail here, where we're now going to use all this other data, or all these other spaces that we removed. So if we go here, and this is to get the minimum equity required, which will flow through all the model. We delete all these rows. Let's see, 83 to 128. And I don't know what's going on with Excel lately, but when I switch between tabs, sometimes it'll hang, like, see this? It doesn't want to give me the whole page. I don't know this is a new thing in the last month or so. It's really annoying. I don't know why it's doing that. Ungroup. Okay, so we want to add, so we've got debt service in here. We need to throw in, we have loan proceeds. Let's see, why is this not coming in? If global control C15 is nothing, okay, so we got to update that formula. So if F4 equals the date of this, Jan 2023 equals, and then we want to pull, if so, pull this amount. There we go. So that's dynamic. All right, and then let's just do all this in one spot. So we have other cash flow items, and we want to put in here cap X, exit proceeds, including land, taxes, startup costs. We have loan proceeds in here. This doesn't need to be formatted, so nice. Okay, so now we plug these in. Give this a little bit of a shade. And then we'll do cash flow, cumulative cash flow, and this will determine the minimum equity needed. All right, so CapEx, let's go to the cash flow statement here, exit proceeds. is basically this in this. Taxes up here. Startup costs here. We got loan proceeds. And now this should be enough so that we can now reconcile these summaries and get a total cash flow that matches. So we go EBITDA. There's no weird non-cash stuff happening here, so we don't got to do any offsets. It's EBITDA minus debt service. We'll add plus CapEx, so that's coming through as a negative, plus exit proceeds. Add taxes. Subtract this. Actually, let's just make everything as a negative if it's coming through. It's a negative. Oop. Alrighty. And you'll see how this then comes back and ties into the balance sheet. So this is going to equal this plus that. So here's the actual cash flow per period. Okay. Now we want the minimum equity required, which is then going to flow through to the balance sheet, and this is how we'll have this cost is going to be covered by that equity, and that's why this equity amount is going to go up, and then we will balance here. So minimum equity is going to be from the minimum in row 90, minimum cash required, $1.3. Now, so that's in here. Let's look at the cash flow. So we have that. Hold on. CapEx. Okay, we need to add the land. Minus annual detail I-34, which was the land. Okay, perfect. So that's going into cash flow. So summing up that, minus, and this is always going to be in period 1. There we have it. Oh, we don't want to drag that over because that just happens in period 1. Okay, now let's go back so you can see the monthly detail now just got a lot more expensive for the min cash. This is now 7.2 million. And you can see the balance sheet's like a giant sanity check. And there we have it. So now that covers the land cost, the value there is matched up, and our balance sheet's all matched up. Let's make sure the annual balance sheet. Okay, so this. Oh, we didn't add the land in here. So this is land. And then we want to say do the same check, but the value we're getting is going to be not an H lookup. Wait a second. Freeze equals global control, H lookup that. Well, if we let's just drag this down, and then global C6. What's that? The end month. Yep. Okay. Balance sheet monthly 5. Okay. Uh, hold on. What? Oh yeah, let's add that. Okay, perfect. So now that works. So there's our land value on the annual. So, uh, okay, executive summary. Let's do distributions now too. So we want to target the cash flow in row 89 for that. Now this is showing what is available to distribute each year based on any positive monthly cash flow periods, but also accounting for, let's see, this is years in row 2. Accounting and any negative cash flows that happen, less the equity that was contributed. So that the equity is used up as you have negative, and then that's how we're going to solve for the discounted cash flow per year. So you can see this is a big negative, but we're using a lot of this equity. Now, remaining equity to use should just be the total equity contribution plus cash flow in period 0. And you can see where that'll match up always. Now this should also match up with this number. Oh, our annual detail needs to be done as well. So let's copy this, paste. And here, these should all be sum ifs. No border. And then that should match the ending monthly cash flow as well. And we'll format these. Okay, and it looks like everything's working here just fine. Let's put this to maybe a 3x. Also, let's end this on the final month of the 5th year. All right, pretty good. Balance sheets are good. Distribution looks good. Lighten up these boxes. Okay, and executive summary. So this was already working fine. It looks like we just have to update the cash flow items. We've got debt service coverage, average EBITDA per golfer. All right, so let's go. So CapEx right here, debt service. We're not putting investor funding on the summary here. It'll be elsewhere. Startup costs, exit proceeds. That. Loan proceeds, that looks correct in 87. This is already in the amortization, the debt service, and then taxes we have here. Okay, so this needs to be a negative. Okay, and now we just simply go EBITDA plus all of this. Now, 9.9601,324. Okay, so that is fine. These visuals are good. This, for our check, the ending balance here should be equal to the ending annual detail cash balance. Okay, we're plugging right along. Visuals, so monthly and annual cash flow. Let's fix these. So we've got monthly cash flows. That. Annual, or I mean cumulative. Okay. So we actually break equity. The break even on the equity happens at exit in this case. Now it could be different if I put different expense assumptions here, for example, or different revenue assumptions, or different cost assumptions. I mean, we've got quite a lot of startup costs here. You're probably not going to spend $500,000 on web design. Maybe 20,000. An app. I mean, if anything, maybe 10,000. Or $100,000 reserve, and then these are just, we'll zero these out. Land purchase, maybe let's go 1,500,000. But you can see how planning out the feasibility here, when you figure out how much you're going to pay to acquire this land and build a golf course on, the numbers here are going to have to coincide somewhat with what you expect to make in revenues or operational cash flow here to pay that back at some point, and that's why you obviously, and then you have the exit. Now with the golf course, definitely the land and all of that, there's, that's an investment in itself. So you might be just playing that and just as long as you can break even then exit, you might be happy. But this is going to let you play with all kinds of different scenarios. So now here, so I adjusted those the startup costs a little bit lower. Now we break even around year 4. Do we want to mess with any of the other charts? I think these are fine. post-tax cash flow. And again, you could just you could not include terminal value, and then it'll just run through just operations. And on the balance sheet now, in this case, it would just run into perpetuity. Whatever the balances are of the debt and assets and all that just will show up on whatever the end month is. Which is fine. This is mainly just for discounted cash flow analysis, because you want some terminal value to be there. Okay, let's look at the cap table. So here we want to update these years. This all looks pretty good. Yep, this is all matching up. So 819.2 and 2.8. Those match. Pretty good deal here for the owners, but obviously they're running the operation as well, so they put up some capital. Again, this is arbitrary. When you go to fill out the cap table, you'll have the minimum equity required based on all the startup costs and any burn here. And then you define where that money's coming from. If you just want to autofill, you can zero out this section and this section, and just it'll all put 100% for the overflow, and it'll all just flow there based on the minimum needed. Or if you're getting investors, then you could put that data in here for outside investors, inside investors, and their share of the stock, which will drive the share of the distributable cash flow. And then I did do IRRs for each individual as well as in aggregate for the insiders and outsiders. Okay, and this looks like it's flowing just fine. I think the only real thing you might want to consider is this cost basis for the land. You might want to put in an arbitrary number for the sale price of the land. And in that case, you'd use the sale price for the cash flow, but then on the income statement, you'd have to include that gain as taxable and then apply a tax rate to that. And then it gets a little bit more complicated to do the formula. So that's why I just did, you've got to exit multiple here. You can apply it to these different fixed assets if there's any depreciation left on them at the end. If not, you just would put 100% for this. And then you can just assume there's also going to be cash flow from the sale of the land, and we're just assuming that's going to be equal to the cost basis. Alrighty. Well, this is pretty awesome. Anyone who's looking to get into the golf course game, you can plan accordingly with this financial model. It's pretty comprehensive. All right, well, let's do some checks. So I want to make sure when I adjust the end month to something different, well, first of all, we got to make sure these are correct referencing. So I-59, that's good. Balance sheet and annual is 61. That looks good. Yep. Uh, Annual check against monthly. That needs to be updated. Yeah. And then annual check against balance sheet. So this has also got to be updated. Minus that. And then here is minus equity required. That should always balance. Executive summary check. Distributions. There's that. Yep. So this is just making sure all the different summaries end up with the same numbers. And then cap table, that's good. Okay, so the real test, let's start changing up some of these assumptions here. So if I put First, I want to check if we're including terminal value, and then let's see if we end on a mid year. It's fine. Let's add a full year earlier. Looks good. Mid year. Okay, so that's good. Now let's put no exit value. Adjust this. Looking good. Looking good. Okay. All right, so all of our numbers match. If we zero out this, still good. Let's zero out this, still good. If we go to debt, if this was some point in the future and we did take on some debt, looks good. Although it's saying we don't need any money here. If we have that much, now hold on. Oh, we've got too much coming in. Wait, what? How is this? How is this equity requirement 0? Oh, wait, did I zero it out? Hold on. Okay, I accidentally zeroed that out as well. Okay, let's go back. Let's put that schedule happening at sometime in the future. Okay, so that's all fine. Balance sheet's still working. Okay, good. So a lot of times when you're doing this, you want to like actually think about what you're inputting here to see if it's logical as well. Like I'm not going to put in um, a terminal value as yes and then hit 0 on this. Obviously that's not logical. If you're including terminal value, then there has to be one. Otherwise you would hit no here. Um, okay. Well, this went pretty well. I'm excited to next week we're gonna probably do the e-commerce model, and then after that we'll do the vending machine, which I'm excited to get those two done. And then beyond that, it's going to be new template time. So I'll build, think of some new industries to get into, and I mean, I might do some Web3 stuff, or just whatever. I'm gonna try and do some more industry specific startup models. Uh, so I'm excited for that. That's cool. Now, if you want to check out more of these or purchase it, the link will be in the description box below. This template is part of the industry specific bundle, which you can get here on smarthelping.com. It'll be right here. I'm going to do the overview video of this tomorrow, probably because I got a bit of custom work to do the rest of today. And don't forget, if you do buy any template, I do offer a 2-hour walkthrough if you want to, of paid work. If you want to kind of help me, if you want me to help you work through what assumptions you have and how they might fit into a given template. And that goes for all the other regular templates as well, not just the startup models. And again, for more, check out Financial Models tab at the top of smartbleed.com. You can buy everything I've ever built for $9.99, or buy in category, or buy individually. Lots of templates here, and again, I can't wait to start adding to this and building new stuff. Finally, it's been 6 months. I've been doing these upgrades of adding three-statement model and cap table and updating these. So I'm excited to be getting close to the end. Alrighty, I'll see.